Listen to me very carefully. I need you to pay attention to what I am about to tell you because this is going to matter a lot. We're going to talk about silver, not because some guy on Twitter told you to buy it, not because some financial guru with a fake Rolex is screaming about it on YouTube. We're going to talk about silver because when you look at the fundamental drivers, industrial demand, supply constraints, investment flows, and macroeconomic conditions, you're looking at one of the most asymmetric risk-reward opportunities in the commodities market today. Now, before I get into the details, let me be absolutely clear about something. I'm not telling you to go out and dump your entire savings into silver tomorrow. That's not how this works. What I am telling you is that the math, the trends, and the structural factors all point toward a significant price appreciation event that could rival some of the biggest commodity rallies in history. And if you understand why, and I mean really understand the mechanics, then you will be in a position to make an informed decision rather than following the crowd. So let's break this down piece by piece. We're going to cover the historical context, the industrial demand drivers, the supply situation, the investment thesis, the macroeconomic backdrop, and the risks you need to understand. By the end of this video, you'll have a comprehensive framework for thinking about silver not as a get-rich-quick scheme, but as a strategic allocation in a well-thought-out investment portfolio. Let's start with some history because understanding where silver has been will help you understand where it might be going. For thousands of years, silver has been recognized as a store of value and a medium of exchange. The metal has been used as currency by civilizations spanning from the ancient Greeks and Romans to the Byzantine Empire and beyond. Silver was literally money for most of human history. Coins minted from silver facilitated trade across continents and empires. The phrase silver tongue exists because the metal was so universally valued that it became synonymous with something precious and powerful. Fast forward to the modern era, the United States operated on a bimetallic standard for much of its early history. With both gold and silver serving as the foundation for the monetary system, the Coinage Act of 1873, which some call the crime of 1873, effectively demonetized silver and moved the United States to a gold standard. This was a pivotal moment that shifted silver from its role as money to its role primarily as an industrial commodity and investment asset. Throughout the 20th century, silver prices experienced significant volatility. In the early 1980s, the Hunt brothers attempted to corner the silver market, driving prices to an all-time high of nearly 50 pay-rounds. That bubble burst silk and silver spenchant wade wantwantwak, foremost off theparitum 1983-22006. Silver traded between $4 and $10 per ounce. It was cheap, it was overlooked, and it was largely ignored by institutional investors. Then something changed. Starting around 2006, silver began a remarkable multi-year rally that would see prices increase more than tenfold over the next 5 years. By 2011, silver was trading above $48 per ounce, approaching the highs set during the Hunt brothers' famous attempt 3 decades earlier. What drove that rally? A combination of factors. The global financial crisis prompted investors to flee to hard assets. Industrial demand was increasing, particularly for solar panels, and investment demand surged as people looked for alternatives to a shaky financial system. That 2011 peak marked the beginning of another extended correction. Silver spent the next decade consolidating, trading mostly between 15 and 25 per ounce. The metal was once again out of favor, forgotten by mainstream investors who were busy chasing tech stocks and cryptocurrencies. But here is what you need to understand: those consolidation years were building a foundation for something potentially much bigger. The key historical takeaway is this: silver has had 3 major price discovery periods in the modern era. There was the Hunt brothers' attempt in 1980, which was ultimately a manipulation play that failed. There was the 2008 to 2011 rally, which was driven by a combination of crisis-era safe haven demand and genuine industrial fundamentals. And now we may be entering a third major price discovery event, one that could dwarf the previous 2 in magnitude. Why do I say that? Because the drivers in place today are more powerful and more structurally embedded than anything we have seen before. The industrial demand is not just growing, it's accelerating. The supply constraints are not just temporary, they're geological. And the investment dynamics are not just cyclical, they're shifting on a global scale. Now let's talk about the real engine behind silver demand, the industrial applications. Silver is the most electrically conductive metal on the periodic table. It has the highest thermal conductivity, it's antimicrobial, reflective, and has unique chemical properties that make it irreplaceable when manufacturers need these properties. They need silver, period. Solar energy revolution. Silver is critical in photovoltaic cells. Each solar panel requires silver paste to conduct electricity. As the world transitions to renewable energy, solar capacity is being added at an unprecedented pace. Global solar installations have grown at compound annual rates exceeding 20%. China alone adds more solar capacity annually than most countries' total installed capacity. The US is accelerating deployment. Europe is scrambling to meet targets. Emerging markets are beginning their own solar revolutions. The solar industry now consumes roughly 150 million ounces of silver annually, and that number is projected to keep rising significantly. Forecasts suggest solar-related silver demand could increase by 50% or more over the next 5 years, with total annual mine production around 800 million ounces. An increase of 75 to 150 million ounces in a single sector is a massive structural demand shift. Electric vehicle revolution. Each electric vehicle contains roughly 25 to 50 grams of silver in electrical systems, charging infrastructure, and electronic components. As EVs move from niche to dominant transportation, silver demand grows correspondingly. 5 grams telecommunications. 5 grams deployment requires enormous electronic equipment base stations. Small cells, routers, switches, each contains silver. As telecom companies invest hundreds of billions in 5 grams, silver demand rises. Electronics growth. Every smartphone, computer, smart device, medical equipment, and automotive electronic system contains silver. This industry has grown steadily for decades with no slowdown. Emerging applications. Water purification using silver's antimicrobial properties is becoming more common. Medical applications continue to grow. Research into silver in advanced batteries and supercapacitors is active. Total global silver consumption for industrial applications is roughly 600 million ounces annually and growing. If solar demand increases by 50% and EV demand doubles over 5 years, that's an additional 100 to 150 million ounces of annual industrial demand. This is not speculative demand, it's real physical consumption by manufacturers who need silver because there are no good substitutes. Here's what most people completely miss. Silver is not just a precious metal, it's a byproduct of mining other metals. Roughly 70% of world silver production comes as a byproduct of mining lead, zinc, copper, and gold. Miners are primarily after those other metals. Silver comes along for the ride. This means silver supply isn't nearly as responsive to price increases as you might expect. Global annual silver mine production is roughly 800 million ounces. That sounds like a lot until you realize investment demand can swing by tens of millions of ounces in a single year based on sentiment. The silver market is physically smaller than people realize. Supply constraints are worsening. Silver ore grades have been declining for years. Miners must process more rock for the same amount of silver. Energy and labor costs have increased. Environmental regulations have become more stringent, adding compliance costs and limiting expansion. Capital intensity of new mining projects has increased dramatically. It can take a decade or more and hundreds of millions of dollars to bring a new mine from discovery to production. The most accessible deposits have been exploited. Remaining deposits are deeper, lower grade, or in more challenging jurisdictions. Major silver-producing countries face structural challenges. Mexico has political uncertainty around mining. Peru has experienced social conflicts disrupting operations. China is reducing mining output due to environmental concerns. Russia faces sanctions and supply chain complications. Recycled silver provides roughly 150 to 200 million ounces annually, but this supply is also constrained. Photography decline has reduced silver scrap sources. Jewelry recycling is counter-cyclical. People sell when prices are high, reducing available supply during rallies. Global silver supply has been essentially flat for the past decade while demand has grown. The silver market has been in structural deficit for several years, annual consumption exceeding new production. The difference is being made up by drawing down existing inventories in vaults and exchange stockpiles. Those inventories are not unlimited. Visible inventories tracked by exchanges have declined significantly. At some point, the drawdown becomes unsustainable. and the market must respond with higher prices to ration demand or stimulate new supply. Given supply constraints, higher prices become the primary mechanism for clearing the market. Investment demand for silver comes in several forms: physical coins and bars, exchange-traded products, futures and options, and institutional holdings. Retail investment. Silver is an accessible alternative to gold. Unlike gold, where an ounce costs over $2,000, silver is affordable enough for ordinary people to buy a few ounces at a time. This accessibility created a huge retail market for coins and bars. Countries like the US, Canada, Austria, and China all mint government-issue silver coins popular with investors. Retail silver demand is sensitive to cultural and media narratives. When financial media talks about inflation or economic uncertainty, retail buying surges. The underlying base of retail silver investors has grown significantly, with many holding for the long-term, exchange-traded products. Silver ETFs now hold hundreds of millions of ounces of physical silver. When these products see inflows, they must buy physical silver. When they see outflows, they must sell. The growth of silver ETFs created a new channel of investment demand that can move markets significantly. Importantly, silver held by ETFs is physical metal taken out of the available market, sitting in vaults, not available for industrial consumption. This creates a captive pool of investment demand absorbing a significant portion of annual production. Futures market. Silver is actively traded on COMEX, with open interest often exceeding several hundred million ounces. Most contracts settle in cash, but physical delivery potential creates a floor under prices. If prices fall too far, physical buyers step in. When speculative positions become extremely one-sided, eventual reversals can be significant. The silver market has historically seen dramatic short squeezes when positioning becomes too negative. Institutional investment. This has traditionally been limited compared to gold. Most institutional investors have mandates allowing gold but not silver. However, this is changing. Some institutional investors view silver as a way to gain exposure to both precious metals and industrial commodities. If this trend continues, it could bring significant new capital. The macro story for silver is arguably more compelling than supply and demand fundamentals alone. Central banks have engaged in unprecedented monetary expansion. The Federal Reserve, European Central Bank, Bank of Japan, and others expanded balance sheets to levels that seemed impossible before 2008. The COVID-19 response accelerated this, with trillions printed and injected into financial systems. What does this mean for silver? When central banks expand money supply, they dilute each unit of currency's value. Simple arithmetic: more dollars chasing the same goods and services raises prices. More dollars chasing finite silver raises silver's dollar price. The relationship between money supply and silver prices isn't perfectly linear short term, but over meaningful time horizons, it's clear. Massive balance sheet expansion since 2008 coincided with structural uptrends in precious metals. Gold made new all-time highs multiple times. Silver also rose significantly. Beyond monetary expansion, we have fiscal deficits. Governments run massive deficits, borrowing trillions annually. This borrowing must be financed through taxes or money creation. The path of least resistance involves monetary financing of fiscal deficits, a structural backdrop supporting hard assets. Currency weakness is also a factor. The US dollar has been world reserve currency for decades, but signs of challenge are increasing. Countries diversify foreign exchange reserves away from dollars. Commodities are discussed as alternatives. Long-term currency dynamics are worth considering. Inflation has re-emerged as a major concern. Housing, healthcare, education, and basic necessities prices rose faster than general inflation for years. Pandemic-era stimulus and supply chain disruptions accelerated price increases. Hard assets like silver historically perform well in inflationary environments, particularly when driven by currency debasement. Global economic recovery has been uneven, geopolitical tensions increased, relationships between major economic powers deteriorated. In uncertain environments, investors increase allocation to hard assets as insurance. The gold-silver ratio represents how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio fluctuated significantly, around 15:1 in ancient times, typically between 15 and 40 during the 20th century. In recent years, the ratio has traded between 65 and 90, currently with gold around 2000 per ounce in 7th or 20s. The ratio is well above historical averages, suggesting silver is relatively cheap compared to gold. Two ways this ratio can normalize: gold falls relative to silver, or silver rises relative to gold. Given strong tailwinds for both metals, the more likely scenario is both rise, but silver rises faster, compressing the ratio toward historical norms. If gold maintains current levels and ratio compresses 250 to 1, silver would trade around 40 pay rounds. If gold appreciates CCCA, silver could reach $50, $60 or higher. These aren't predictions, they're illustrations of potential magnitude if the ratio normalization thesis plays out. Key insight: silver offers leverage that gold doesn't. Because silver is a smaller market with lower absolute prices, percentage moves are larger. In strong precious metals markets, silver typically outperforms gold on a percentage basis. This leverage amplifies both gains and losses, which is why silver is more volatile. For investors allocated to gold, adding silver increases leverage to the precious metals thesis while diversifying. For investors bullish on hard assets seeking higher potential returns with corresponding risk, silver-focused allocation makes sense. Section 7. Comparison to other assets. Compare silver to stocks. The market delivered solid returns over the past decade, but valuations are stretched. P or E ratios are high. The market is concentrated in mega-cap technology companies. Returns potential from current valuations is more limited than a decade ago. Compare silver to bonds. Yields were artificially suppressed. Many bonds offer negative real yields after inflation. The bond market faces risks as rates rise and central banks unwind. For income investors, bonds are less attractive than in decades. Compare silver to real estate. Strong performer in many markets, but valuations stretched. Mortgage rates rose significantly, reducing affordability. Demographic trends are shifting. Real estate is highly illiquid and requires significant capital. Compare silver to cryptocurrencies. Crypto captured imagination. Some made significant profits. But cryptocurrencies are highly speculative with no fundamental value floor. Regulatory uncertainty is high. Volatility is extreme. For alternatives to fiat currency, precious metals offer more established and lower risk options. Compare silver to gold. Gold is traditional safe haven and performed well, but gold prices appreciated significantly. Current valuations may account positive factors. Silver's lower starting point and industrial demand drivers create potentially more attractive risk-reward for precious metals exposure. Silver versus other commodities. Copper, aluminum, lithium saw appreciation driven by energy transition and supply constraints, but silver has unique dual nature: industrial commodity and monetary metal. This means silver benefits from both industrial demand growth and investment demand from monetary and macroeconomic concerns. I need to be honest about risks. Nobody should invest without understanding what could go wrong. Economic weakness. If the global economy enters significant recession, industrial demand for silver would fall sharply. Solar installations delayed, EV production slowed, electronics manufacturing contracted. Severe recession could overwhelm investment demand drivers and push prices lower. Technological substitution. While silver is currently best conductor for many applications, efforts to reduce usage or find substitutes continue. Some solar manufacturers develop cells using less silver. Research into alternative materials progresses. Significant breakthroughs could reduce or eliminate some demand. Mining supply increases. Supply constraints are real, but if silver prices rise significantly, mining companies have incentives to increase production. Secondary supply from recycling would also increase. Higher prices ration demand. The silver market has historically been more responsive to price increases than many anticipate. Manipulation and price suppression. Silver has long history of manipulation allegations. The Hunt brothers episode and ongoing COMEX concerns. Derivatives heavy pricing can create short-term dislocations working against investors. Volatility and timing. Silver is volatile. Prices swing significantly in short periods. Even if long-term thesis is correct, timing matters. An investor buying at an unfortunate moment could see position decline significantly before recovering. Psychological pressure causes people to sell at precisely wrong time. Liquidity. During market stress or extreme demand, physical delivery can be difficult. Some ETFs suspended redemptions during dislocations. The small physical market compared to investor demand can create bottlenecks. Correlation with risk assets. In some environments, silver correlated with stocks rather than acting as safe haven. During March 2020 COVID crash, silver fell sharply along with equities before recovering. Diversification benefits aren't guaranteed in all conditions. Government policy. Governments could impose precious metals ownership restrictions, tax policies could change, regulatory changes could affect ETFs or investment vehicles. These risks are low in developed countries but worth acknowledging, given the structural demand growth, supply constraints, macro backdrop, and appreciation potential. How should you approach silver investment? Understand your time horizon. Silver isn't a get-rich-quick play. Fundamentals are structural and long-term. Industrial demand growth is a decade-plus trend. Supply constraints are geological and permanent. Macro shift toward hard assets is generational. If your horizon is less than 3 years, silver may not be right. If you're thinking 5, 10, or 20 years, the thesis becomes compelling. Size your position appropriately. Given volatility and risks, never allocate more than you can afford to lose. Silver should be part of diversified portfolio, not the entire portfolio. Some investors allocate 1-2 precious metals generally, with silver as a portion. Stronger convictions might justify 5-10, few circumstances justify 20% or more. Choose your vehicle carefully. Multiple ways to invest exist. Physical silver coins, bars, rounds provides direct ownership. You hold it, store it safely, own it outright. Downsides, storage costs, insurance concerns, illiquidity when selling. For small to medium positions, physical silver in safe deposit box or reputable vault works. Silver ETFs provide convenient exposure without physical storage. Products like eShares Silver Trust SLV hold physical silver and trade like stocks. Convenience is attractive, but counterparty risks and annual fees exist. During market stress, ETFs suspended redemptions or traded at premiums or discounts to NAV. Mining stocks provide leveraged exposure. When silver rises, mining company revenues increase. Operating leverage amplifies percentage gains. But mining stocks carry company-specific risks: operational, political, management. For those understanding the sector and comfortable with stock risk, mining stocks can amplify returns. Silver futures and options provide direct exposure with leverage but require active management and can result in significant losses if prices move against you. Appropriate only for sophisticated investors understanding derivatives and tolerating volatility. Consider dollar cost averaging. Given volatility, many investors find accumulating silver gradually over time effective. Buying fixed dollar amount each month or quarter smooths entry price and reduces lump sum timing risk. Stay informed but don't overreact. Silver market attracts noise, irrationally bullish cheerleaders and dismissive bears. Neither extreme helps. Stay focused on fundamental drivers, industrial demand trends, supply developments, macro conditions, valuation metrics. Let underlying thesis guide decisions rather than short-term price movements or media hype. Looking out over the next decade and beyond, powerful trends should support silver prices. The energy transition is just beginning. Solar and wind capacity needs massive expansion to meet decarbonization targets. Silver is essential. Electric vehicles will go from small fraction to dominant transportation. Each requires silver, 5 grams, and eventual 6 grams. Networks require enormous electronic infrastructure. On supply side, geology hasn't changed. Most accessible deposits exploited. New discoveries increasingly rare and challenging. Mining is capital intensive with long lead times. Even if prices rise significantly, new supply takes years to come online. Monetary backdrop unlikely to change dramatically. Governments and central banks demonstrated willingness to expand money supplies when faced with economic challenges. Political path of least resistance involves currency debasement rather than fiscal restraint. Structural headwind for paper currencies, tailwind for hard assets. Demographic trends are worth considering. Populations age in developed economies, transition in developing ones. Savings patterns shift. People approaching retirement typically increase hard asset allocation. Millennials, the largest generation, are entering peak savings years. Their investment preferences will shape markets for decades. If industrial demand grows 5-10 annually, supply remains constrained. Macro conditions stay supportive and investment demand grows as more investors discover the silver thesis. We're looking at a structural bull market lasting years or even decades. I'm not predicting straight line higher. Markets don't work that way. Pullbacks, corrections, and consolidation periods will occur. Factors discussed could change. New technologies could emerge. Economic conditions could shift. Future is inherently uncertain, but if you're looking for asset with structural tailwinds, limited supply, growing demand, and historically elevated valuations with room to mean revert, silver is one of the most compelling opportunities in commodities. Silver is unique, combines industrial and monetary characteristics. Industrial demand driven by energy transition, EVs, electronics, and 5 grams infrastructure, all long-term structural trends continuing years or decades. Supply constrained by silver being byproduct of other metal mining, unresponsive to price increases. Investment demand grew through ETFs and other vehicles, creating captive physical demand pool. Macro backdrop: supportive monetary expansion, fiscal deficits, inflation concerns, currency uncertainty all favor hard assets. Gold-silver ratio historically elevated, silver cheap relative to gold. Ratio normalization suggests significant appreciation potential. Risks are real: economic weakness, technological substitution, supply response, volatility, policy changes could all impact prices. No investment without risk. For investors with appropriate time horizons, risk tolerance, and conviction, strategic silver allocation makes sense as part of diversified portfolio. Position size should reflect individual circumstances. Investment vehicle should match capabilities and preferences. Dollar cost averaging can help manage timing risk. Final thoughts: listen to me very carefully. I'm being straight with you. The silver thesis outlined here is based on analysis of fundamental factors and macro trends. I've been honest about opportunities and risks. I've avoided hype and empty promises, but at the end of the day, you make your own decisions. Nobody knows for certain what will happen with silver prices. Nobody can predict the future. What we can do is analyze available information, understand forces at work, and make informed judgments about risk and reward. If you decide silver is right for you, approach it as strategic investment with long-term perspective. Don't panic if prices fall short-term. Don't get greedy and over-leverage. Stay focused on underlying thesis. Most importantly, only invest money you can afford to lose. If you decide silver isn't right for you, that's perfectly reasonable. Every investor has different circumstances, risk tolerances, and convictions. My bullishness doesn't mean you have to be. What I hope you got is a framework for thinking about silver not as get-rich-quick scheme, but as serious investment opportunity with real fundamentals. The decision of whether and how to invest is yours. If you want more content like this, honest, no-nonsense analysis of financial markets and economic trends, hit subscribe and follow Markology. We break down complex topics with real numbers and real analysis, not hype and not guru nonsense. And if you have specific questions about silver or want me to cover other topics, drop them in comments. I read every comment. Your questions help shape future content. This is Markology. We're making sense of your money in a confusing world. I'll see you in the next video.